Meet Marcus. He is doing something incredibly difficult, building first-generation wealth from scratch. Without an inherited family safety net, every dollar he saves feels like a hard-won victory, bringing an immense amount of pressure to protect it. If a family's primary earner suddenly dies, the surviving members often have to liquidate assets simply to survive. Years of careful saving, investing, and debt repayment can vanish in a matter of weeks to cover basic living expenses. Looking for a way to secure his family's future, Marcus encounters a slick online pitch for something called a 7702 plan. The agent describes it as an elite, government-sanctioned retirement vehicle used by the wealthy to dodge taxes. But 7702 is actually just the section of the IRS tax code that defines standard life insurance. The pitch gets aggressive. The agent warns Marcus that buying standard, affordable term life insurance is a terrible idea. They tell him it is throwing money away, leaning heavily on the statistic that roughly 98% of term policies expire without ever paying out a death benefit. When you are desperate to protect your family from poverty, that framing works. The fear of leaving loved ones unprotected makes well-meaning buyers highly vulnerable to sales tactics that disguise expensive insurance policies as secret wealth-building investments. At its absolute baseline, life insurance is a simple contract. You pay a premium to an insurance company, and if you die while the policy is active, the company pays a tax-free lump sum, a death benefit, to your beneficiaries. Term life is pure temporary protection. It covers you for a set number of years, usually 10, 20, or 30. You buy it to shield your family only during your most financially vulnerable decades, like while you are raising children, paying off a heavy mortgage, and building your savings. Permanent life insurance, which includes whole life and universal life, is designed to last until you die. Because the insurance company will eventually have to pay the death benefit, these policies cost significantly more, and they include an embedded savings account known as cash value. This chart shows the massive cost disparity between the two options. For a healthy 30-year-old male seeking $500,000 in coverage, a 20-year term policy runs about $26 a month. A whole life policy for that exact same $500,000 death benefit will cost hundreds of dollars a month. Waiting to buy changes the math, but term remains highly efficient. If you wait until age 40 to buy that same term policy, your premium will bump up to around $40 a month. It is a noticeable increase, but it stays drastically cheaper than the permanent option. That massive gap in monthly premiums is the catch. The permanent policy's cash value isn't free money generated by market magic. It is entirely funded by your own overpayments. You are simply paying the insurance company extra to hold on to your cash. The reality of that cash value account is often disappointing. Your extra premium dollars are constantly chipped away by internal policy charges, heavy administrative fees, and steep surrender penalties if you try to access your own money in the early years of the policy. Universal life policies carry a specific dangerous trap. They allow for flexible premium payments, but if you do not pay enough, or if underlying interest rates drop, the policy's internal costs will eat the cash value alive. The entire policy can collapse, leaving you with zero coverage and zero cash. Permanent insurance does have mathematical validity in specific scenarios. If you need to fund a trust for a special needs dependent who requires lifelong care, or if you have an ultra-high net worth estate that will face massive inheritance taxes, a lifelong death benefit is a necessary tool. Pitching permanent life insurance to an average earner without lifelong financial liabilities acts as a heavy anchor on their monthly budget. It drains cash that could be used for highly efficient, liquid investing, forcing them to overpay for protection they will eventually outgrow. Marcus stops worrying about which financial product sounds the most sophisticated. Instead, he asks a highly practical question. What exact dollar amount does my family actually need to survive if I die tomorrow? He sits down and maps out his family's future liabilities. He calculates the cost of replacing his income for the next 10 years, the exact balance remaining on the mortgage, and the projected costs for future childcare and college tuition. He also adds the immediate, unavoidable costs of death. An average funeral runs roughly $7,700, a sudden expense that routinely forces grieving families into high-interest credit card debt. This equation shows the final step in calculating true insurance need. You take the total liabilities, income, debts, future goals, and final expenses, and subtract your existing assets, like current savings and any basic life insurance provided by an employer. The resulting number is your actual coverage gap. Armed with his exact number, Marcus builds his plan. He buys a 20-year term life policy that covers his exact gap for $25 a month. Then he takes the hundreds of dollars he would have spent on a whole life policy and aggressively invests it in low-cost index funds to build liquid wealth. He no longer feels the anxiety of a fragile financial foundation. He has secured a massive, guaranteed payout that will activate if the worst happens, giving him the total freedom to focus on growing his assets. Affordable term life insurance acts as a defensive wall. It ensures that while you do the slow, steady work of building true generational wealth, a single tragedy cannot wipe your family out.